So welcome back to my channel. In today's video I'm going to teach you about the turtle soup setup or turtle soup strategy. So this trading strategy is designed to identify potential market reversals and by taking the advantages of the liquidity imbalances. Okay, so the basic concept of a turtle soup strategy is to identifying the liquidity and imbalances in the market. It aims to capitalize on false breakouts where price briefly moves beyond a significant level before reversing. So let's see it over here. So for example, market is doing a normal thing like higher high, higher low, higher high, higher low, and higher high like this. Okay, and now you can see that this is all of this is high low, high low, high low, right? So from this higher high and from this high low there will be some sort of break and retest. So now all of the stop losses of the retail traders, those who took the buy from here, their stop loss will come just below of this low. Okay, so now in our turtle soup strategy what we'll do is we'll look for false breakout or we'll look for false break of structure. Okay, so now what will happen is the price will go down and it will go and take this low like this, and then we the traders, those who are looking for this turtle soup setup, this is a pure turtle soup setup. Okay, it went down and now everybody is thinking, so all of the guys those who were in this price leg, they thought like it is a bullish move. So when price was coming down from here, okay, they were looking for buys till the price came down and took this low. So all of their stop losses, those who were looking for buy over here, all of those guys stop losses were taken when price went down of this. So now all of those buyers are gone. Okay, so now there's a market structure shift. Okay, now some people will look for break and retest. They will think that price will tap on this zone and then it will fall down. But what will happen is now there will be some traders, those who trade supply and demand. Well, now what they will do, they will think that this is a new price leg and they will do this Fibonacci. Okay, and or they can think that this is a supply zone. Okay, because they can see that this is a break of structure, but this is not a break of structure. It's nothing but a liquidity which is taken from below of this low. Okay, so now as a turtle soup, as a guy who is trying to find out turtle soup setup, we know that price has taken the liquidity from below of this low. So now our entry will be right over here and our target will be these highs. Okay, because we know people will sell from here and their stop loss will be somewhere around over here. So now this will be our target. So now when price will go up from here like this, now in this price legs, okay, the people those who sold in this price leg, what they will think like that if price is going up like this slowly and like it's going up, so what they will do, they will look for sells. Okay, in this price leg they will look for sells at 0.5 level of Fibonacci or 0.708 level of Fibonacci, and in last they will look for sell from this supply zone. Okay, but it's not possible, as we all know that this was the liquidity grab right over here. Okay, and the turtle soup strategy can be a false breakout. So for example, if price is doing something like this, okay, it's doing consolidation right now, and then all of a sudden it goes down like this. Okay, now the retail trader, what he will think is like he will think that this is a breakout, right? So when he will think that this is a breakout and he will look for sells from this level, so when price will go up from here and retest this level, he will look for sells over here. Okay, or some of the traders like those who got a little bit advanced from beginners point of view, from beginners they've like one step ahead, what they will think like this is a supply zone over here, or they will use a Fibonacci. Okay, like this. So in this price leg, first of all, people took buys on this level. Okay, on this level people took buy, but what happened was price went down, took this low, so all of their stop losses are taken. Okay, and now in this price leg, if price will go up from here like this, people will keep on selling and price will keep on going up, and then it will retest on this level first. People will sell over here, but price will go up. People will sell over here also at 0.5 level. People will still sell on the 0.705 level also, and then price goes up and taps into this supply zone, and people will think like, yeah, this is the last demand zone, so they will take a sell one more time. But this what will happen. Okay, it will go up and take the stop losses of all the traders those who were over there. So what was this? This was the false breakout, right? So this is a false breakout, but we as a trader, those who are trying to find out turtle soup setup, price went down in 1 or 2 pips. So when you can see that prices went down of this relative equal lows, or it went out of this consolidation from 1 or 2 pips below, we will just place our buy limits and we will place our stop losses on the basis of our risk management. Okay, and then we will target this high for 1:2 at least. Okay, like this we can target 1:2 and we can easily get into a winning trade. So this is a ICT Turtle Soup strategy. Okay, so first, so I think so you understood the basic. So now the strategy steps. Okay, first is identify the key levels. Okay, so identifying the key levels, the first step is to find support and resistance lines on the charts. Okay, so in this scenario you have to find out support and resistance line in the chart, which is very important because lots of normal traders or beginners traders, they use like supply and demand. Okay, so now over here let's see let's go into 3-minute time frame. This is a pretty good level, right? It was a demand level over here, then it was like it was a resistance level over here, and there was a resistance level over here also. So first you have to find out the support and resistance levels on the chart, and these levels are typically significant. So with the swing highs and swing lows, round numbers, or the price levels where the market has reached strongly in the past. Okay, so first one is the swing highs and swing lows. So we can see that there is a this swing high, and there was a this swing high over here. Okay, and there was a this swing low over here. So we can see all of that. Okay, and there's for the support and resistance, this was the support and resistance line, and I should show you this one also. Wait, this was also a good support. Okay, but price came down and took the low over here. But first we should look for this swing highs and swing lows, and then the round figure numbers. So for the round figure numbers, we can see that this is a round figure number right over here is 1.08500. Okay, it's a round psychological level, and these round psychological levels are good. I can say that these are the good support and resistance. So if traders, those who are listening me, and they think that they will keep on trading the support and resistance, so please do one thing for change, so they can use this round psychological levels little bit into their trading. So round psychological levels are this 1.08500, and then 1.0800, and another ones are like this 1.09000. Okay, so these are the round psychological levels. All right, so now we should look for these round psychological levels, and over here also look at over here. So this was the round psychological level over here. So this is a good support, this is a good resistance, this is a good resistance zone. So when price went up, tapped into this round psychological level, and it gave a good a good reaction from that level. Okay, so everybody, those who saw this price leg from here, and they saw that price is doing some sort of price is at this specific level over here. Okay, so now they're looking for sells from when they saw that price tapped into this level. But what happens after that? The ICT Turtle Soup, what happened? The price went up one more time, took this high, and did a consolidation over here to make people fool that some sort of this break and retest is going on over here. Okay, but what happens after that? It made a false move like this to create a narrative that this is a break and retest, but our sell will be right above of this little bit, 1 or 2 pips or 5 pips above of the high, like this. Our sell will be right over here, and our stop loss will be 10 pips. Okay, or you can do 15 pips. It's based on your risk management, and our target will be 1:2. So this is our trade. Okay, and this is a support and resistance. So you can see this type of support and resistance, and another one is a strongly reacted market levels. Okay, so like for example over here, market reacted really well. Okay, and over here also these two relative equal lows, and there are lots of the like these highs. So when in future price will go above of this, or these levels will pull the price towards them like a magnet in future. Okay, so these are like these levels are extreme levels, and these levels are like external liquidity, not internal liquidity, because this high over here was internal liquidity, right? But if price would have gone and taken this high, this would be external liquidity. But price took the high, and then it falls down, and our entry will be just a little bit above of this level. Okay, so over here also, okay, if you guys can see that price gave us some sort of break and retest. Okay, it gave a good break, and then it retests that level, and then it falls down, and then people, those who saw this bearish leg like this, they will sell, then price will go up till the 50%, they will sell, price will go a little bit more up, they will sell at 0705 level, and when price will go at this level one more time, they will sell, and they will think like this is a supply. But what happens after that? Price goes up, takes that high, and then it starts to fall. And then there was this 8:30 news or something, it went one more time, took that high, and then it starts to fall. Okay, so now there will be some traders, those who took a buy also from here from 0.5 level like this. Okay, they took a buy because they saw this bullish engulfing, but no, you should know the narrative of a higher time frame. Okay, so I hope you understood the first step to identify key levels of significant swing highs or swing lows, and support and resistance, and around psychological level. Okay, and the second part is to wait for the breakout. So when we saw this good move, and we saw this swing high right over here, in this scenario it's a swing high, and there's a break and retest. Okay, so this is a resistance, this is a support, this is a level. Okay, support and resistance level like over here, and we can see a swing high also over here, and we can see a what we call it, the supply zone also over here. Okay, from this wick, so you can see 3 of them are lining over there. So now we will wait from London session. See at the time below. Okay, it's like 2 o'clock. Okay, so I should do this. See at the time below. Okay, it's like 2:15. So like London session starts, and it takes the whole London session to go up and take that high. Okay, so now when we saw a move, and we can identify that this is a demand zone, and we can identify that this is a bearish move over here. So now we are looking for a breakout. Okay, we're looking for the breakout of this high, or of this supply zone. Okay, we're looking for the breakout, and now look for the false breakout. So when price goes up and it takes this high, and if it gives a quick movement towards the downside, okay, because it will be really quick, it will not take too much time. Okay, if it goes a little bit above of this, there are lots of liquidity, it will push the price towards the downside. Okay, and now you can see that it went down a little bit, but there was a New York session. So New York session wants to take the high of the London session and Asian session both. So I should mark the London session and Asian session. The London session was from 2 to 5. Okay, so this was the London session low, and this was the London session high. So in New York session, what happened? Like price went up, took this high of London session, and then it started to fall down. Okay, and then it came back up one more time to retest one more time on this level. But as we all know, price can go up and take this high, and then it can start to fall. Okay, so now we should look for false breakout. When price gave a false breakout like this, okay, now there will be our entry point. Okay, we will look for entry just a little bit above of this swing high, little bit above of this swing high. Okay, just place your limit over there and just put your stop loss like this, and you can target for 1:2. Okay, this will be your entry point. So look for the false breakout. So now the forex signals of a potential false breakout. So now you should set up your stop loss and take profit. Okay, so now in my scenario I can say that you should wait, you should do your own risk management, because I cannot tell you the risk management, because everybody have a different account capital, because I was thinking about that. Everybody have a different account capital, so they have another risk management. So I hope you should understand what will be a risk management. But I can say that the turtle soup strategy is nothing but a in a 3-step process. Okay, first, to identify the key levels. Identify key levels means like just identify the swing highs and swing lows, support and resistance levels on the charts, and then supply and demand. Okay, and the round psychological level, or a strong point, like a strong swing point like this, a big move like this. Okay, and then when you saw a leg or a move like that over here, then just wait and look for the break. Just wait for the breakout of that swing high. Okay, just wait for the breakout of that swing high. So when the breakout happens of that swing high like this, that's the opportunity for us, the traders, those who are looking for turtle soup setup. We have the opportunity to get into the market. Okay, then only we'll place, or you can place your limits over here, or if you want to do a market execution manually, you can do manual execution also, but you should be fast. Okay, you should be fast at clicking the sell buttons and to calculate the lot size. But you can place your limit over there, and then you can place your stop loss like 15 pips or 10 pips above, and you can target for 1:2. I should say you should target for 1:2, because 1:3 is like the winning percentage of 1:3 is 40% or 50%. But to get 1:2, you can get like 1:2 60 or 70% of the times. Okay, in a winning trade. So I hope you guys understood these 3 levels, and it's an easy setup. That's why I taught this one. Well, it's a 3-step process. Just identify the key levels, wait for the breakout, and look for the false breakout, and then take the entry on the false breakout. Because with the breakout like this, people will look for buy over here, and you should do the opposite. Okay, that's the turtle soup strategy. And now for the key points. Okay, the key points are the ICT Turtle Soup strategy is based on the concepts of exploiting market inefficiencies and false breakouts. Okay, and the second one is it requires patience to wait for the false breakout and confirmation of the reversal. Okay, and proper risk management is crucial with well-defined stop loss and take profit. Okay, and another one is the trader often use additional things, like they use order blocks or fair value. You can use that, but I don't think so that you will get time to. You will get time, because see, price moves fast from when it takes that high or when it takes that low. Okay, when it takes the swing high or swing low. Okay, it moves fast, and it's hard that price will give you a time to get in. Okay, that's why I placed it, because over here also you can see that there was a small little fair value gap like this. Okay, now some of the SMC traders, like what do the mistakes they do, they will see this, they can understand that price has taken the swing high over here, and they can see that liquidity is taken over here, and now they can see a break of structure also, right? The market structure shift, they can see the market structure shift, because it was bullish from the morning from the London session, but now we can see a market structure shift and this swing low taken, and they can see that there is a fair value gap also right over here. Okay, so what they will do is they'll take the entry from this fair value gap, which is nothing bad. Okay, they can take the trade from this fair value gap, and now the problem is that they will take, for example, they took the sell from here. Okay, and now the problem is that they will place the stop loss just above of this high. Okay, and now they will target for, if they close it on 1:1, or if they close some partials on 1:1, they're safe. But if they target for more, because I know lots of the traders, they want 1:3 or 1:2. So now this what happens. Okay, instead of waiting for fair value gap or this 705 retracement, okay, of the 705 retracement of Fibonacci retracement, or for waiting for the order block to get hit, why not you just place your limit little bit above of this swing high like this. Okay, when you see this type of candle, just place your limit right over there, and just put your stop loss, put your this of 10 pips. Okay, now see over here, price goes down, and you have enough room, like it will be every time it will be a sniper entry, it will never go into too much drawdown. This went up because of the news, because there was a news of what you call NFP or out, but the most of the time it will never go into a deep drawdown. Okay, it can go into deep drawdown sometimes, but if you are on a right bias and you are taking trades with this type of good swing highs, so then it will be a sniper entry. Okay, so now as with the trading strategy, it is important to first practice on a demo accounts or with a small position sizes. Okay, first to understand how it works in a real market conditions, because you should know that how it works in a real market condition, because if you are not trading it on a real markets, or you should use this strategy with a demo account. Okay, and try to take setups like this, and this setups happens every day, on every time frame, on every pair. Okay, it happens every time, this type of, because every time price is seeking for liquidity, so every time there will be a false breakout. So if you can make profits from the false breakout, so why not? Okay, so that's what I'm trying to explain. And then another one is it's also recommended to combine this strategy with the proper risk management, because no matter what strategy you are using, okay, if you don't have a good risk management and money management, because in short I can tell you that what's a good risk management is like following the particular risk which you think that don't go over. So if you took 2 or 3 winning trades, okay, and now you see 3k or 4k in profit, okay, and now you can think that, okay, I have 4k in profits and I usually risk 1000, like 1% of 100k account. What if I risk more than 1% or 2%, and I'll just make a 1:1, and I will just take that 1:1 and I will make 2% with one small trade, just a little bit of small trade, and you will get in with that $2,000 risk, and it will just take a tiny little bit. It will go tiny little, like slowly it will go into your drawdown, and then you can see that it has gone below of the 1000, and now you will lose the half of the profit which you have made. Okay, so that's like a bad risk management. Risk management is like always risking the amount which you thought, and which is like mentally you are good with it. Okay, there's a two type of loss. There's a loss which is mentally loss, and another is a financial loss. Because if you take a loss on this, so for example, instead of risking like a 2000, if you would have risked like 1000 or 500, then it would have been not a big deal. Okay, then that trade would have been not a big deal. Like, okay, it's a loss, it's a 1% loss, but you didn't follow the risk management. You just took the trade with a 2% risk. So that's why that trade was big. That trade had a big impact on your mind. Okay, on your subconscious mind, that, oh shit, like I lost that one, and now you will try to make the 2000 back, and then you will lose your money. So that's a bad risk management. Good risk management is risking a one thing, okay, one price, okay. And now a good money manager is like, if you lose the first trade, okay, if you lose the first trade, then what will happen is, then just cut down the risk on the second trade, okay, and then if you lose a second trade, then cut down the risk also one more time, half of it. So for example, if you took the first trade of $1000, okay, and then you took the loss on it, you took a one loss on it, okay, $1000 loss, then jump back to $500 trades, risk 500, and now you took another loss of 500, okay, now risk 250, okay, so now you're risking 250, and now you took another loss, 3 losses in a row, okay, so now if you calculate that, the 3 losses in a row, it will be $1750, okay, it's not even a 2%. You lost 3 trades, and you still lost only three. You still lost like only 1750. Okay, you still lost like $1750. But if you would have risked like 1% on every trade, then you would have lost like $3000. Okay, so a money management is this. So okay, so from that the third trade you took another win. So you took a win of $250, and then you made like 1:2. So you made 500. So when you made 500, now what you can do is you can increase your risk, because you decrease your risk when you took the losses, and then increase your risk when you're taking profits. So it will be like being aggressive and defensive at the same time. Okay, so when you make a win of 500, so now risk 500. Okay, and now you win the 500, and for suppose you made 1:2 only. Now you made like 1000. Okay, so now you made like 1000, and then you got 2 wins, and then one more time risk like 1000, the initial risk, which is 1%. So that's a good money management, and that thing comes with the experience. Okay, so that will be the money management and the risk management. Okay, so like if you use that money management and risk management, and if you use this turtle soup strategy, which is very simple, I should say it one more time, the steps. Okay, the first step is identifying the key levels. Simple. How you will identify the key levels? By looking at the swing highs and lows, round psychological numbers, and support and resistance levels, and good price, like, or good point of the price from where market reacted strongly in the past. Okay, and the second one is the wait for the breakout, okay, of the swing high of the supply zone or the demand zone. Wait for the breakout of that, and when you see the breakout, then look for the false breakout. And how you will look for the false breakout? Just look for a quick move, quick reverse from there. Okay, so you can see a quick move, or you can see price moving fast from after going into deep into two pips or 3 pips into that stop losses, like over here. Okay, you can just look, or don't take a quick, just place your limits over there. Okay, so you place your limits over there, and you can place your stop losses like 10 pips or 15 pips on the basis of your pair. You're trading euro dollar or you're trading gold, it's based on that. And then just target 1:2 or 1:3 in the trade. Okay, and now you can do this thing on 15-minute chart, you can do this on daily time frame, you can do this on everywhere. Okay, like look at over here also closely. This was the good relative equal lows, right? Over here, this was a good demand zone because price reacted from here. But what happened? Price went down, took that low. Over here, people thought that this is a breakout, but as a trader, we will buy over here and we'll place our stop losses a little bit below, and we'll buy when price will go a little bit below of this swing low. So I hope you guys understood what I was trying to explain. And the turtle soup strategy is really important because this is a simple strategy from which you can easily find out liquidity. Okay, you can just look for the swing highs and swing lows. Just wait for the false breakout. Just wait for the false breakout from. Okay, just wait for the false breakout, because I can see breakout everywhere. Okay, a false, like over here also there was a false breakout, and then what happened? Price kept on falling. So every time look for a false breakout. Okay, and then you take your trade or place your limits over there and just target 1:2. So that's how simple it is. Okay, so I hope you guys understood this concept, and if you guys have any questions, just you can comment down below in the comment section. And if you like this video, so drop a like, share it with your friends, and subscribe for more content like this. And give me suggestion if you want a video on a particular topic, if you want a video on a risk management, or if you want a video on anything, any point, or if you want to understand a little bit or you're confused a little bit, just write down in the comment section and I will just make a video on it. So until next time, wish you good luck and be safe.